Chinese officials are vowing to fight to the end in response to President Trump's latest tariff threat, raising the risk of a prolonged trade war between China and the U.S. Meantime, Japan is taking on a dramatically different approach. Japanese stocks rebounded on the news that the country will get priority in trade talks with the U.S. following a call between Japanese Prime Minister and President Trump. Joining us now to discuss what's next for trade and the markets, Jay Pelosky, TPW Advisory founder, and Anthony Saglimbene. He is Ameriprise Financial Chief Markets Strategist. Thank you both for being with us this morning. Jay, I want to start with you because I've been intrigued talking with you about China and the broader Asia trade in the past couple of, it feels like, years here. Talk to me about how you view these negotiations with Japan and Japan getting kind of the first round at these negotiations. What does that tell you about an investment thesis when it comes to Japan?
Well, Japan is actually a market that we've been invested in and we think is appealing for a number of different reasons. And I think that the opportunity here is for capital to really repatriate out of the United States back into Japan, as well as other countries such as Europe, et cetera. And that should really be supportive for Japanese assets. There's an issue with a stronger yen being problematic for some of the exporters. But overall, I think the opportunity in Japan is that you have domestic capital reallocating from fixed income to equities as inflation picks up, deflation is defeated, and then you have the potential for money that's been invested in the United States to flow back to Japan. But to be honest, Madison, the market in Asia that we're really focused on is China. And I think the action today is really illustrative. Namely, Trump has threatened to double tariffs, as was discussed. China said, we're not going to cave, and the markets are up. And so to me, that's a sign that the markets are reading this as kind of the end of the beginning, and we're going to be in negotiation mode, which means things are going to get better, not worse. And I think that's why you see the market bouncing.
And so, Anthony, with this in mind, I mean, we're talking about 50% right now, but Trump campaigned with this 65% marker that a lot of analysts were taking into account. So it seems like there could be a ratcheting higher if the negotiations don't net out positively for what both sides are looking for here.
Yeah, I think that's right. I mean, I think investors were kind of stumped at the beginning of all of this with the focus on Canada and Mexico, and China seemed like they were getting off. And now we have really aggressive tariffs against China, which was the focus during the campaign. And so I agree with kind of the sentiment that's here. The focus is starting to turn to China much more aggressively. Negotiations are opening up possibly with some of our other trading partners. Markets were very oversold coming into Monday. You saw a little bit of capitulation trading on Friday and a little bit on Monday. It's obvious that the market wants some good news on trade. And so I think as we move through the coming days and coming weeks, it's really about what can we get out of the White House that's a little bit more positive than just aggressive tariff actions. Negotiations are a good starting point, and it's why you're starting to see stocks start to rebound a little bit this morning.
Negotiations may be a good starting point, but as you put it, Jay, negotiations could be just the end of the beginning here. So what does that tell us about how real this bounce is? Is this just a little bit of dip buying and then we're going to still end the week down in the red again?
Yeah, Madison, it's very binary, right? If we are in negotiation mode, and I think we are, right? I think Treasury Secretary Bessent is out there making it abundantly clear. We're open for negotiation. And that's to provide the president with a couple of wins so he's more comfortable moving off this tariff structure, and we can all relax a little bit, not have a recession, in which case stocks are probably quite attractive here, right? We look at the VIX volatility, and historically, when the VIX trades over 40, 45, 50, which is where it's been, 1 year out, returns are quite solid. And so it's really this idea of if China and U.S. fight and we get into a massive, Chinese devaluation, stocks go down dramatically, we have to price in a recession, we're going lower. Or we're not going to have that outcome. Things are going to negotiate. Tariff rates are going to come down, recession is going to be averted, VIX is going to collapse, and you've got lots of upside. So that's really the binary nature. But to us, it's clear the White House has been scared by the market reaction. The market has bounded Trump, who heretofore has been unbounded, right? No one can move him off this issue. The market, I believe, have moved him off this issue.
Jay, super quick, because I want to bring Anthony back into the conversation, but do you think Trump cares about the stock market right now? He's continued to reiterate that he doesn't.
His donors do, his supporters do, and they're making it abundantly clear that this needs to be fixed. Musk, Ken Griffin, Larry Fink, Ken Lagone. I mean, the list goes on and on.
I want to allow you to comment on that, Anthony, with the additive of this, because it seems like the relief will come in the form of exemptions as well, as long as this negotiation goes forward as intended for a lot of those donors, as well as the major mega profiles that showed up representing, some of them, the Magnificent Seven on Inauguration Day.
Yeah, I agree with the concept. The companies are very concerned about the tariff environment over the next couple weeks and couple months. Markets were, like I said, very, very oversold, and it was a warning that when markets get this depressed, it generally precedes a recession. And so I think whether you're in the White House or whether you're a corporate executive, you're looking at the current environment and you're a little bit nervous. And so what we've been telling investors is that at some point, negotiations may lead to maybe less steep tariffs than the market has feared. Valuations have improved in the stock market. Diversification is working. Bonds are mitigating some of the risks in stocks. And so over time, if we can see better trade kind of commentary out of the White House, then I do think investors will maybe step back some of their more aggressive fears around recession and start to look at some of these really attractive valuations in Mag 7 and even some of the financials and industrial companies that have moved aggressively lower. There could be some opportunities for longer term investors. And just lastly, really quickly, the most volatile days come around these periods of uncertainty. And you generally see the best days in the market kind of coincide with the worst days in the market. So the best strategy for most investors is to stay the course and stay invested during this period of uncertainty.
And that's such a good reminder. 30 seconds left. What is your single best investment idea? What's your playbook?
Diversification. Bonds and cash are holding up. Alternative strategies are doing well. And I think you need to start looking at stocks in some of these areas in the U.S., like the Magnificent Seven, that if you have a longer term time horizon, you can invest in. Lastly, international investments add and round out that diversification.
And Jay, let me get that from you for 30 seconds before we wrap up. What's your single best investment idea, especially when you look global?
Yeah, we want to be overweight non-U.S. equity. We think that's the opportunity set. Better policy flexibility, fiscal and monetary in Europe and in Asia and China, for example. Cheaper markets, under-owned markets, better earnings growth. So the opportunity set here in the pullback, and we've been saying this for a month or more, we want to sell U.S. RIPs because we think the upside is capped. We want to buy non-U.S. dips. That's what we've had. We like China. We like emerging markets. We like Europe. We think the opportunity set there is much better than in the U.S. because we believe capital repatriation out of the U.S. back to Europe and Asia is a central theme that we're just beginning.
Anthony, Jay, thanks so much for the time this morning. 15 minutes until the market open. We'll leave the conversation there.